Welcome to investingnews.com. We're once again speaking with Simon Wensley from Metro Mining. Welcome back, Simon.
Great to be back, John.
Oh, you're welcome. We recently discussed where bauxite fits into the critical mineral supply chain. Today, investors would like to know where the bauxite mined from the company goes and how this actually fits into the current energy transition space.
No, excellent question. John, look, the bauxite is the only way in which you can make primary aluminium. So bauxite makes alumina in a refinery and then that gets smelted into aluminium. So all of our bauxite pretty much goes into that value chain. And aluminium is the most important metal in the energy transition. And whilst everybody would know about its use in construction, sort of window frames, doors, furniture, etc., and also in food packaging, its strongest growth areas are in effectively transportation and in renewable energy and its transportation. So, for example, we're seeing lightweighting now of all forms of transportation. Obviously, it's been used in airplanes for a long time, but what we're seeing now in vehicles is increasingly 300 to 400 kilograms of aluminium being used in every vehicle. That's to make them lighter and I guess for batteries to take them further. And then the batteries themselves, aluminium is the second most important element in those batteries after graphite. Probably the biggest growth though will come from renewable energy, and you can't have a solar panel without aluminium. So the frame of the solar panel, and importantly the structure, the what holds up the solar panels onto the roof and supports it, is all made from aluminium. Again, meant to be lightweight and durable, so weather resistant. There's a lot of forecasts out there, but I tend to quite like using the World Bank. They're predicting that aluminium will grow over 120% in their central scenario. That's what they call their 2-degree warming scenario. So the base case is a 4-degree warming scenario to 2050. They use a sort of a base case of elements in the economy effectively limiting that to 2 degrees. In that particular case, then there's going to be 120% growth in aluminium. So put that in perspective, that's more than copper, lithium, cobalt, and all of these rare earth metals all combined. Aluminium will grow faster and to a greater extent than all of those elements. And so in solar panels alone, there will be 50 million tons of aluminium going into solar panels over that same period. So if you kind of effectively, work that out, I mean, that is over 300 million tons of bauxite just going into the growth in the solar panel space. The other aspect is in energy transmission, and people often think about copper as being the most intensely used metal in the transportation of electrons, but actually aluminium is more intensely used in grids than copper is. So again, these are the sort of driving forces behind copper growing at above GDP rates of around 3 to 4%, and that's going on globally. So obviously, in the larger economies like China, India, in Southeast Asia, Latin America, these are the ones that are going to see the highest growth and the highest demand for aluminium. So it's a really important growth story. It's what we sort of saw maybe 20 or 30 years ago in steel, that we're now seeing in aluminium. So it's a road that's been trodden before.
Okay, Simon, well, staying on the macro narrative, what's the market outlook for demand and global bauxite production prices?
Yeah, well, look, that's the natural follow-on question, and similar, as I said, to what happened in steel and iron ore, 25 years ago, is now happening in bauxite. So what we've seen in the last 4 years since COVID is double-digit demand for traded bauxite. So that's seaborne bauxite that is put on ships and moved around the world, and we've seen over 10% growth in the last 4 years. Now, where that's stemming from is that top side demand from aluminium, but also what we're starting to see is also shortages of traditional sources of bauxite. China themselves, a strong producer of aluminium, a strong producer of alumina. Their traditional domestic bauxite resources are dwindling and are continuing to do so on the back of grade constraints, of cost, of environmental constraints, etc. And so there's been a significant demand out of China as they've been growing, but they can't get the bauxite. Similarly, in India, Middle East, they're also short of bauxite and are growing and are likely to continue to grow over the next 5 to 10 years. And we've also seen supply side constraints. So Malaysia was a supplier in the last decade. They've pulled out. Indonesia in the last couple of years have also pulled out of supplying bauxite into that traded market. So that's really left two major suppliers. One is from Guinea in West Africa, and the other one is Australia. Both of them have huge resources of bauxite. And the difference, of course, though, is that Guinea is a long way away from the big growth market in Asia. And so Australia, we have a very natural advantage there, and not only from the distance and I suppose the risk perspective from a sovereign risk point of view. There's also this issue of instability in some of those West African countries, and in particular Guinea has been through quite a bit of disturbance over the last couple of years as the illegitimate military government has been trying to run that country. So they're coming up for elections. That's going to drive a bit more instability in that country. But I guess what we're seeing from our customers is a real push for supply diversity and supply security. So, obviously Guinea's a big supplier, and so they will be taking volume from them, but they know there are risks there, and they're looking at getting a strong base load also from Australia. And that's where Metro has grown on the back of that demand and over the last few years, and we've now established ourselves as a large and reliable supplier into that Asia Pacific market.
The most important one for investors moving to the company's financials: how is increased production impacting margins?
Well, increased production in any bulk commodity is crucial, because what tends to happen, bulk commodity mines tend to have a high proportion of fixed costs. That's especially so for us, because we have a very remote operation in North Queensland, and so our fixed costs are probably upwards of 80% of our total costs. So the way that you are able to generate margin is by expanding production, and that's exactly been what our strategy has been over the last three or 4 years. So back in 2021 we were producing, when I joined Metro, a run rate of about 2 million tonnes per annum. We steadily increased that. We've invested cash flow back into the company. We've done an expansion of our production, and so this year we've effectively implemented all of those measures and are starting to become consistently operating at around that 7 million tonnes per annum. And so that expansion has allowed us to offset those fixed costs against a larger production base. And so what you see then is our costs of production going down. We even believe that if we can implement all of these expansions and all of the improvement programs that we have underway, that next year we've said to the market we're targeting to be the lowest cost supplier into the Asia Pacific market, and we're on track to be able to do that. So cost of production is critical for a bulk commodity. That enables us to withstand all the ups and downs of a price cycle, which we know will still be there come what may in these markets. But at that low cost, we can weather those cycles and produce a reliable margin in all of those periods. So if we can do that, and I'm confident that we can, given that we're putting in plans in place for next year now already, getting our contract base there, then generating significant margins, even if prices do weaken, enables us to generate that sustainable cash flow. Now, the first port of call for that is to pay off or offset debt. We've already done that significantly in 2024. We paid off about $40 million of debt in 2024. our senior debt this year started to amortize, and we'll have paid off about 26, 27 million dollars of debt this year, and that leaves about just over 60 million dollars of Australian dollars of debt in the company. By the end of this year, at the end of this operating season, we should be pretty close to net cash with that. So we'll have about the same amount of money in the bank as we have in debt. So that's a great place to be. We then our production drops significantly during calendar Q1 of every year due to the North Queensland wet season. That gives us plenty of cash flow to be able to work through that, do maintenance works, etc. And then we'll be coming back into operation around the middle of March. And so, look, we've also put in place a capital management policy this year. So we're, obviously with any spare cash, we'll be considering, how much money we put back into the company in terms of sustaining and growth capital, but also, then if we have spare cash, what we do for shareholders in that space, whether it's share buybacks or dividends when that time arrives. So all of these things are under consideration and likely to be employed over the next 12 months.
Thank you, Simon. Now that we understand the production side, how will exploration continue so you can, otherwise you're depleting your asset?
Yeah, correct. Look, we've got about 11 years of reserve left in our current ore bodies. There are an additional, 40 plus million tonnes of resource as well that's sitting outside of the reserve category, and we're looking at those at the moment and looking at what we have to do to upgrade those to bring them into the reserve category. And that's all sitting around our current Skardon River sort of south operation where we've been operating for the last 6-7 years. What we also though have done is started with exploration this year. So north of the Skardon River we have two quite large leases, and we know there's bauxite there, so we have done a first cut exploration program up there this year. So been gathering samples, and that's about to come to an end now. And we've also got some leases down south of Weipa in the roundabout very near the Aurukun township. So we've started to negotiate some access agreements with the local body corporate there to be able to access and do some exploration on those leases next year. We've also got a couple of other leases around in the same sort of Weipa bauxite plateau, some a little bit further north, some a little bit further south, but we'll be steadily looking at all of those, looking at accessing those exploration leases over the next couple of years to try to understand what's there, and then if possible put them into the reserve and resource base to extend the life of the operation.
Finally, Simon, what are the key near-term catalysts investors should monitor?
Well, we're coming to the end of our calendar and financial year, so our guidance at the moment has been set to 6.4 to 6.6 million tonnes for this calendar year. So we'll be announcing where we got to that at the end of December. We've had a pretty good November so far, so that will certainly be a catalyst. We're also negotiating and locking in volume for next year from a sales and marketing point of view, and we'll update the market on that as well over the next sort of month or so. I'm heading off to China again next week to try and finalize some of those volume allocations for next year with customers. And it's quite a dynamic space, as I mentioned earlier, with new alumina producers coming on and others expanding, etc. So it's there's a lot of opportunity there for us. So those are probably the near term, and then we'll release our fourth quarter announcement, operational activities announcement by the end of January, and then our full year results will be announced before the end of February.
Simon, thank you very much for updating investors today. We look forward to chatting to you again soon.
Great. Thanks for your time.